question on group accounts, or basically a question on consolidated financial statements. So maybe first of all, we need to ask ourselves, what are the group accounts, or what are the consolidated financial statements? So these are the financial statements which are prepared by something called a parent company, or by a company which is known as a parent company or a holding company, by combining or basically by consolidating similar items of assets and liabilities, revenue and expenses, those of the parent and those of the subsidiaries. So from company law, I hope you can be able to remember what is a parent company, or what is a holding company, and basically what is a subsidiary. A holding company, or basically a parent company, is a company which has acquired the majority of the shares, or basically more than 50% of the shares issued by another company. So the company which has acquired majority of the shares is known as the parent or the holding company, whereas now the other company is known as the subsidiary company. So like assuming in this case we have a company A, and you are told that this company has acquired more than 50% of the ordinary shares, basically which are issued by company B. So in this case, this company here is known as the parent company. In other terms, this can also be known as the holding company, whereas this company here is known as the subsidiary company. So now, this company, which is called the parent company, at the end of each year, is basically expected to prepare the group account or the consolidated financial statement. And we are saying that these group accounts are prepared by this company by combining similar items, of assets, liabilities, revenue and expenses, those of the parent company and those of who? Of the subsidiary. And in this case, it is very, very important for you to understand that these group accounts are not prepared by any other company, but purely they are prepared by the parent. So it is not the subsidiary company to prepare the group account, but the group account should be prepared by who? The parent company. So therefore, as far as this topic is concerned, we're going to look on how we prepare the group account. And also, in this case, we're going to discuss in detail some of the accounting standards, which basically governs the preparation of this particular group account. But even before we proceed to do that, to look on those specific standards, to look on how we prepare the group account. First of all, I want us to maybe look on definition of various terms. So these are some of the important terms we need to understand even before we proceed to prepare the group account. The first term here is basically called, or the first term is group. And in this case, when we talk about the group, basically this refers to the parent company and its subsidiaries. The parent company and its subsidiary company. So meaning that if, for example, we have this company and this company has one subsidiary, or maybe this company has two subsidiaries, then we refer to this as a group of companies. So the parent company and its subsidiaries are known as a group of what? Of companies. So in this case, we have said whenever you have a group of companies, then you have said that this company here, that is the parent company or the holding company, is the one which has an obligation to prepare the group account or to prepare the consolidated financial statement. So the other term we can also define here is the parent, or basically the holding company. And we say that this is a company which controls, this is a company which controls another company, and the other company which is controlled, in this case, we refer to it as a subsidiary company. So this company, the parent company, controls another company which is known as the subsidiary. Basically, control is determined in terms of checking the percentage shareholding. So if this company here has acquired majority of the share, more than 50%, we say that this company controls the other. Though this control is not, or basically the control does not exist, whereby a parent company has acquired majority of the shares. Generally, we say this company controls this one. Number one, if the parent company controls the composition of the board of directors. What does that mean? It means that if this company here, company A, appoint majority of the directors in company B, So then in this case, we say that this company here controls the composition of the board of directors of company B. Number two, this company will also be deemed to be controlling this one if this company here basically do what? It controls, we can just put that there, it controls the operating and the financial decisions of the subsidiary. And actually, in this case, the parent company controls the operating and financial decisions made by the subsidiary if this company here is the one which appoints the senior managers of this company. So the parent company controls the operating and financial decision of the subsidiary by doing what? By appointing the senior managers. By appointing the senior managers, in the subsidiary company. So if the senior managers of the subsidiary company are appointed by the parent company, then in such a case, we say that this company controls what? Controls a company B. So therefore, it is very, very important for you to understand here that you may be told that this company here, for example, acquired like 45% of the shares issued by company B, but company A is the one which appoints majority of the directors. It also appoints the senior managers of company B. In that case, the control exists. Yes, so in this case, we continue. So what I've said is that if you are told company A maybe acquired like 45% or even 50% of the shares in B, then you also given information that company A is the one which appoints majority of the directors in company B. Company A is the one which appoints the senior managers of company B. It basically means that company A exercises control over company B. And therefore, company A will be the parent, company B will be what? The subsidiary. So the other term we also need to define here, number 3, is the term business combination. Business combination. So what do you mean by business combination? The business combination basically we say is the event, or is basically that transaction where the parent company acquires control in the subsidiary company. That transaction where the parent company acquires the control in the subsidiary company, we refer to that transaction as a business combination. In other terms, we say company A has actually acquired company B. That transaction itself, we refer to it as a business what? A business combination. The other term we also need to understand here, which is number 4. Number 4 is something called non-controlling interest. Non-controlling interest, or basically NCI. And NCI, this refers to the shares issued by the subsidiary company, and not held by the parent. So these are basically the shares which are issued by the subsidiary company and not held by the parent company. Not held by the parent company. What does that mean? Let's assume that we are told that this company here, that is the company A, has acquired 80% of the ordinary shares issued by company B. So it means that 20% of the shares issued by company B, 20% of the shares issued by company B, which is a subsidiary, they are not held by the parent company. The parent company only holds 80% of the shares issued by company B. And therefore, these 20% of the shares issued by the subsidiary, they are not held by the parent company. We refer to that portion of the shares as the non-controlling interest. So we say that these particular shares here are held by the minority shareholders. The minority shareholders are not in a position to control the operating and financial decisions of company B. They are not in a position to control the composition of the board of directors of company B. That's why we say their stake, their interest in this particular company is what? Is a non-controlling interest. So these maybe are some of the terms you need to understand even before you proceed to look on how we prepare the group what? We prepare the group account. Then from there, we can proceed and look on some of the standards which are applicable in preparation of the group account. So we look on international accounting standards and also international financial reporting standards, which are applicable in the preparation of group accounts. In the preparation of group accounts, so which accounting standards are applicable in the preparation of group accounts? So here we have a basically number of standards which are basically applicable. So let's proceed. In this case, we have various international accounting standards, international financial reporting standards, which are applicable in the preparation of group accounts. So number one, we have international financial reporting standards number 3, and basically this deals with the business combination. Remember, in this case, we have defined a business combination as that transaction through which the parent company acquires the control over the subsidiary. We're going to look on what is the provision of this standard here as far as the business combination is concerned. The other standard which is also applicable in preparation of group accounts is IFRS 10. And basically, this deals with how we prepare a consolidated financial statement, specifically whereby the parent company has made investment or has invested in a subsidiary company. How do we prepare group accounts? How do we prepare consolidated financial statements whereby the parent company has invested in a subsidiary? The other accounting standard which is also applicable here is IFRS 11, and basically this deals with how we prepare the group account, whereby the parent company has entered in something called a joint arrangement. We will be able to discuss this later on. And then from there, we also have international accounting standard number 28, and basically this deals with how we prepare the consolidated financial statements, whereby the parent company has invested. The parent company has made investment in an associate, or basically joint venture. So these are basically some of the accounting standards which you're going to come across as far as this topic is what is concerned. I want us to start with the first standard here, IFRS 3. IFRS 3. Which basically deals with the business combination. The business combination. So remember, business combination, we have said, is the transaction through which the parent company acquires the control in the subsidiary. Now, this particular standard requires that on the date of business combination, on the date of the business combination, or basically on that particular date, when the parent company acquires the subsidiary, the parent company must determine the goodwill arising from business combination. So therefore, this particular standard here basically governs how the goodwill arising from business combination, so how this particular goodwill should be computed. Should be what? Should be computed. So first of all, what do you mean by goodwill? Goodwill, basically, this is the difference between goodwill is the difference between the purchase consideration which was paid. The purchase consideration, in other terms, we refer to this as the cost of investment. The cost of investment and the fair value of net assets acquired. Fair value of net assets acquired. So the difference between the purchase consideration which was paid by the parent company in acquiring the subsidiary and the fair value of the net asset acquired, we refer to that as what? The goodwill. For example, in this case, we may be told that when the parent company was, or maybe company A, which is the parent company, acquired like 80% of the ordinary shares issued by company B, and this company paid automatically whenever a company is buying shares of another one, that company must pay for those shares. So the amount which is paid is what you refer as the purchase consideration or the cost of investment. Remember, our company is investing in acquiring a subsidiary. So that investment costed company A how much? we may be told that this company paid 100 million. Paid 100 million. That is a purchase consideration or the cost of investment. So in this case, what we do, we compare this purchase consideration which was paid with the fair value of the net assets which were acquired. Automatically, whenever this company is being acquired, that company must revalue the assets, must determine the fair value or the current market value of each asset. So like in this case, assuming we are told that on the date this company was acquired, maybe it's net assets. The net asset of this company had a fair value of maybe 200 million. 200 million. 200 million, or let's just take this to be 100 million. 100 million. So to determine the goodwill, we are saying we take the purchase consideration which was paid. How much is that? Is 100 million. We less the fair value of the net asset acquired. In this case, we take the net asset of this company, which were 100 million. 100 million. But because our parent company acquired 80% of the shares in company B, the parent company didn't acquire all the shares of company B. The parent company also acquired acquired net assets equal to 80%. So therefore, the net asset acquired will be 80% of this. Will be 80% of that. So the difference between 100 million and basically 80 million, which is 20 million, this one we say is the goodwill arising from what? Arising from business combination. The goodwill arising from the business what? Combination. So this particular goodwill basically is determined in accordance with IFRS 3. IFRS 3, basically we are saying this deals with or governs the aspect of business what? Combination. It requires that on the date of acquisition, on the date the parent company acquired the subsidiary, in this case, the parent company must determine the goodwill arising from business combination. The goodwill arising from business combination. So naturally, I've said goodwill is the difference between purchase consideration which was paid and the net asset which were acquired. Now, according to this standard here, there are two methods which can be used by the parent company to compute this goodwill. Two methods of computing the goodwill. Methods of computing goodwill. Computing goodwill. And basically, whatever we are discussing here is very, very important. Very, very important as far as this topic is concerned. You'll be able to see that even before you look on an illustration, as far as this topic is concerned, I think we will take two classes. Today's class and in our next class, here will be an introduction to this topic. So we are laying foundation. We are laying foundation on this topic because we are saying this topic is very, very important. Whatever we are discussing today and actually what we will discuss in our next class is very important. You must understand it. Otherwise, if you don't understand what you're discussing, you will then have a problem when you start doing some illustration. Whatever we are discussing here is one of the very important concepts because you'll come across this in all questions for group accounts. So how do we compute this goodwill arising from business combination? We have two methods. We have the first one, which is called the partial goodwill method. The partial goodwill method. And number two, we have the full goodwill method. We have the full goodwill method. So those are the two methods which are used in the computation of goodwill. And basically, once we look on how we compute the goodwill under the two methods. And we will start with the first one, which is the partial goodwill method. A partial goodwill method, partial goodwill method. Now, even before we look on how we compute this, the goodwill under this method, let me have a small illustration here, assuming we have company A, and this company we are told acquired 80% of the shares in company B. In company B, in this case, we have said 20% of the shares issued by this company, they are referred to as NCI. 20% of the shares issued by company B. Those are the shares which are not held by the parent. So under this particular method here, under this method, we compute the goodwill we compute the goodwill of the parent company only. Under the partial goodwill method, we compute the goodwill of the parent company because it is important to note when computing this goodwill, we are saying we compare the purchase consideration paid and the net asset acquired. Basically, the net asset acquired in this subsidiary. So the net asset of this company have been acquired by the parent company, and some of them have been acquired by who? The minority shareholders, the NCI. Let me just use that word, non-controlling interest. So the shares issued by the asset of this company, 80% acquired by the parent, and basically 20% acquired by who? NCI. We are saying under this method, we only compute the goodwill of this company. It basically means that in computing that goodwill, we will compare the purchase consideration which was paid by the parent company in acquiring 80% of the shares here and the net asset the parent company acquired. So the net asset acquired by the parent will be 80% of the net asset of the subsidiary. That's that? Yes. So therefore, under this method, we compute the goodwill of the parent company only. So how do we compute that goodwill? How do we compute the goodwill arising from business combination? Goodwill on acquisition, the computation of goodwill on acquisition using the partial goodwill method. So here we take the purchase consideration, which was paid by the parent company. So how much amount was paid by the parent company in acquiring 80% of the shares in the subsidiary? And then to this we less fair value of net assets, acquired by the parent company. Fair value of the net asset acquired by the parent company. Like in this case, I've said to compute this fair value of the net asset acquired by the parent company, you take the parent company shareholding in the subsidiary, you multiply that with the subsidiary company fair value of the net asset at the date of acquisition. At the date this company was acquired, what was the fair value of its net asset? This is something which the examiner will not have given you, but basically will be able to explain how do we compute that. So you less that. Whatever you get here will be a goodwill on acquisition if basically you get a positive figure, but there are some instances whereby you can get a negative figure. So if you get a negative figure, it means that whatever the parent company paid in acquiring the net asset of B was less than the net asset acquired. So if you get a negative figure there, that one is called a gain, is referred to as a gain on bargain purchase. A gain on bargain purchase. In this case, we say that the parent company was able to bargain and it acquired the subsidiary at a profit, or basically at a gain. It was able to bargain, it acquired the subsidiary at a gain or at a profit. Now, this goodwill, this one is recognized as an asset, or basically as a non-current asset in the consolidated statement of financial position. So when the parent company here is preparing the consolidated balance sheet, the consolidated statement of financial position, which is basically prepared by adding some assets and liabilities of the parent and those of the subsidiary, this one will be recognized there as an asset. As what? As an asset. But this one, a gain on bargain purchase, this one is recognized as part of the other incomes, in the consolidated income statement. When the parent company is preparing the consolidated income statement, which is prepared by combining revenue and expenses of the parent and that of the subsidiary, this one is recognized there as part of the other income. So therefore, under the partial goodwill method, we compute the goodwill of the parent company only, and basically that is how we compute that. Purchase consideration which was paid by the parent minus the fair value of the net asset which was acquired by who? The parent. But in this case, it is also important for you to note here, or basically what is important to know here, is that in most of the exam questions, the examiner will not have given you some information that use the partial goodwill method, use the full. In most of the cases, if the examiner or if the group, the parent company, or the policy of the group is to compute the goodwill using the partial goodwill method, in the additional information, you'll come across this statement. You'll come across a statement that it is the policy of the group. It is the policy of the group to measure NCI at their proportionate share. Their proportionate share over fair value of net assets. So once you come across this particular statement, in the additional information, is upon you to know that you use the partial goodwill method. You'll come across this statement in the policy of the group to measure the NCI at their proportionate share of the fair value of the net asset. So once you were given that information, you automatically know that when computing the goodwill, the method to be applied is what? Is the partial goodwill method. The other method, let's move to method number 2, is the full goodwill method. The full goodwill method. Now, under this particular method here, that is the full goodwill method, we compute the goodwill of the parent company and the goodwill of the NCI. The goodwill of the parent, the goodwill of who? Of NCI. Remember, the net asset acquired in this or the net asset of this company are acquired by two categories of shareholders. They are acquired by the parent company, who is the majority shareholders here, and they are also acquired by the NCI, who are the minority shareholders here. So therefore, the parent company, when acquiring 80% of the asset, it pays some purchase consideration. When the minority shareholders are acquiring 20% of the net asset here, they equally pay purchase consideration. So under this method, we compute the goodwill of the parent and the goodwill of who? Of the NCI. So the goodwill which is computed here is the goodwill of the parent company and the NCI. Parent company is the majority shareholder, NCI is the minority shareholder. So how do we compute that goodwill? That goodwill on acquisition. Using what? Using this method here, using the full goodwill method. So here we start with the purchase consideration. Purchase consideration paid by parent company, paid by parent company. So how much amount was paid by the parent company in acquiring the shares? And then to this, we add something called the NCI at fair value. So what is NCI at fair value? NCI at fair value is something which the examiner will have given you in most of the questions. So the NCI at fair value, in other terms, this is the purchase consideration paid by minority shareholders, paid by NCI. So when NCI were acquiring 20% of their shares, how much amount did they pay? So we basically add those two values. We add those two values, and this now will give us the purchase consideration paid by the parent and who? NCI. Then from there we proceed, and then we left the net asset acquired by both the parent and also who? NCI. So to this we left. To this total amount we left. And the fair value of net assets acquired by the parent and the NCI. We less the fair value of the net asset acquired by the parent and NCI. So I've said I'll be able to show you how we compute this one. So on the date this company was acquired, on the date the subsidiary company was acquired by both the parent and the minority shareholders, what is the fair value of each net asset? I've said that is something which the examiner will not have given you, but basically I'll show you how we compute that. So we then start from this amount. We can get a positive figure or basically a negative figure. So if it is a positive figure, I've said that is a goodwill. But if you get a negative figure, that one is called a gain on bargain purchase. A gain on bargain purchase. A gain on bargain purchase, of which you have said this one is an asset in the consolidated statement of financial position. This one is an income in the consolidated statement of financial position. So in the consolidated statement of profit or loss. Now, this basically how we compute that goodwill using the partial, using the full goodwill method. But equally, in an exam, the examiner will not tell you use full goodwill method. The examiner will never tell you that. So mostly in the additional information, you will come across this information. You'll be told that it is the policy of the group, it is the policy of the group to do what? To measure NCI at fair value, in which case the examiner will proceed and give you something called the NCI at fair value. NCI at fair value is given, or will be given, that is. Will be what? Will be given. So the examiner will give you this, the NCI at fair value. He will tell you the NCI at fair value on the date of acquisition was this particular amount, So therefore, once or for you to use the full goodwill method, usually you'll come across this particular information in the additional information. It is a policy of the group to measure NCI at fair value, and the examiner will move or basically will proceed and give you the fair value at the NCI at fair what? At fair value. So therefore, that is basically very, very important as far as the computation of goodwill is concerned. We have said goodwill is the difference between purchase consideration paid and the fair value of net asset acquired. How many methods can be used by the company in the computation of goodwill according to IFRS, full goodwill method and the partial goodwill method? You must be able to know how do we compute the goodwill using the full goodwill method and also the partial goodwill method. But here there is something which is very, very important, which I've said the examiner on no question for group accounts. You'll be given that, and that is basically the fair value of the subsidiary company net asset on the date of acquisition. That is something which the examiner will not have given you in most of the questions, or actually in all questions. How do we compute that? How do we compute this? The fair value of subsidiary company net assets on date of acquisition. On date of acquisition. And basically this is the date the parent company acquired the subsidiary. So that in short form we abbreviate it as DOA. So anytime you hear of DOA, is basically the date there was what? There was a DOA. A DOA is basically a wedding. Is the date these two companies came together. Is the date this company did what? Acquired the subsidiary. The date of acquisition. So basically, this is something you will never be given in an examination. Now, net asset generally, net asset here, net asset, there are two approaches we can compute this. You can take asset of the company minus liabilities. That will give you net asset. Alternatively, you can compute net assets by taking equity of the company. Equity we know is the share capital. Share capital plus reserves. Plus what? Reserves. In group accounting, we compute the net asset of the subsidiary using the second formula. We don't use the first one. We don't use this one, asset minus liabilities. We use this one, where we take the share capital of this company automatically on the date of acquisition, and then we add the reserves of this company on the date of acquisition. So therefore, this one is equal to the subsidiary company ordinary share capital plus something called the pre-acquisition pre-acquisition reserves. Pre-acquisition reserves. So what do you mean by the pre-acquisition reserve? Pre-acquisition reserve, these are basically the reserves of the subsidiary, or the reserves the subsidiary company was having on the date it was acquired. On that date, when the parent company acquired the subsidiary, which reserves were in the books of account of the subsidiary on the date of acquisition. And actually, we know the reserve comprises of things like the retained earnings, the share premium, and so on. So therefore, to compute this one, what we do is that we take the subsidiary company, ordinary share capital, and then to this we take the pre-acquisition retained earnings. So this is the retained earnings of the subsidiary on the date it was acquired. On the date it was acquired, we also add the pre-acquisition share premium, the pre-acquisition revaluation reserve. Let me have that here. The pre-acquisition revaluation reserve, a pre-acquisition revaluation reserve, and basically we add all this. So this now will give us the fair value of the subsidiary company net asset on the date of acquisition on DOA. So this is very, very important when it comes to the computation of the goodwill. This is where majority of the students have a challenge. They are not able to compute the fair value of the subsidiary company net asset on the date of acquisition. So we compute it using that formula. A subsidiary company ordinary share capital plus the pre-acquisition reserve. These are the reserves the subsidiary company was having on the date of acquisition. On the date of what? Acquisition. So therefore, as far as the computation of goodwill is concerned, basically those are that's what you need to know. What is goodwill and the two methods of computing the goodwill, and equally this one. How do we deal with this? Now next, I want us to look on this one, forms of purchase consideration. Forms of purchase consideration. Now, purchase consideration, first of all, remember you have said that this is what the parent company pays after acquiring majority of the shares in the subsidiary. So automatically you have said that once this company acquires majority of the shares of the subsidiary, the parent company must pay for those shares acquired. The same case, if you buy shares in a company, you must pay for those shares. Now, the purchase consideration paid by this company can take various forms. So the first form of purchase consideration is something called a cash consideration. The cash consideration. Basically, cash consideration, this is a consideration which is paid in cash, and also it is paid on the date of acquisition, on the date of DOA. So is where the parent company acquires the majority of the shares in the subsidiary, it pays for those shares in cash, and that payment is made on the date of acquisition. Now, this particular consideration here has no special treatment. When it comes to the computation of goodwill, so this particular consideration has no special treatment. So we use the amount that it is. So if you are told the parent company acquired 80% of the shares in B, paid a cash consideration of 100 million. When computing the goodwill, you use the amount, you use that consideration as 100 million. You use it as 100 million. That's why we are saying that that consideration has no special treatment. Number two, we have a deferred consideration. A deferred consideration. So What do you mean by a deferred consideration? Basically, we know to defer is to postpone something to it in the future. So this, number one, is a consideration to be paid in future from the date of acquisition. So this is a consideration payable in the future. Consideration payable in the future. In the future. For example, in this case, we may be told that A Limited acquired 80% of the shares in B, but this company promised to pay an additional consideration of maybe 200 million in 2 years' time. So mean that this particular amount here will be paid at the end of the second year from the date the parent company acquired the subsidiary. Now, this amount here, which is to be paid at the end of the second year from the date of acquisition, remember it forms part of the purchase consideration. When computing the goodwill, which has to be computed on the date of acquisition, this amount has to be used because it is part of the purchase consideration. Therefore, such a consideration which is payable in the future, this one has to be discounted. This one is discounted to its present value, using the parent company cost of capital, using the parent company cost of capital. So the parent company cost of capital essentially would be your R. We know that whenever you're discounting, whenever you're getting a present value, you must have this one. You must have a discount rate. So in this case, you will always be given the parent company cost of capital. You discount it. Like in this case, let's assume that we are told company A acquired 80% of the shares in company B, and this company here promised to pay an additional consideration of 200 million, and this will be paid at the end of the second year, from the date of acquisition. Basically means, from the date of acquisition, this amount of 200 million will be paid at the end of the second year. We are saying, because this particular amount must be used in the computation of goodwill, and we compute the goodwill on this date, we can only use it on we can only discount that amount to its present value. To do that, we use the parent company cost of capital. And then in this case, we are told that the parent company cost of capital, the parent company cost of capital is maybe 10%. 10%. So how do we discount this one? How do we get the present value of this deferred consideration? So the present value of the deferred consideration will be equal to 200 million. We multiply that with the present value interest factor at the rate of 10%, and basically for 2 years. For 2 years. That amount will be paid after 2 years. So we take 200 million, we multiply this with the formula, or basically with this present value interest factor. So in this case, you have to recall, how do we compute this? It's something you did in FM. We take 1 plus R raised to power negative, and remember, this is not an annuity. This is just a single amount. These are a single amount to be received after 2 years. So that is the formula which we use here. So 1 plus R, which is 10%, it will be 1.1. 1.1, we raise that to power negative 2. So our end there will be 2 years. So this will give us now the present value of the deferred consideration. The present value of the deferred consideration. So maybe you can work out this 1.1, which is raised to negative 2, raised to power negative 2, and this will be 200 million times 0.8264. 8264. I hope that is what you're getting. So we multiply the 2.8264 times 200. So this will give us 165.28 million. So when computing the goodwill, this deferred consideration, which is a consideration to be paid in future. We don't use it as 200 million, but basically in this case, we are saying we get its present value. Its present value will be 165.28 million. So any consideration to be payable sometime in the future must be discounted to its present value using the parent company cost of capital. Then we have the other consideration, because we have three main forms of purchase consideration. We have the last one, which is called the share exchange consideration. The share exchange consideration. Share exchange consideration. So what do you mean by the share exchange consideration? So this is a consideration which is paid by the parent company by issuing its own shares. The parent company issue its own shares as a form of payment. It is important for you to note that whenever a company is paying for an asset acquired, for services provided, for goods purchased, the company can pay for those goods, or the company can make the payment in cash, or the company can issue its own shares as a form of payment. You see, share is an asset. So instead of the company paying for goods or services in cash, the company can issue its shares as a form of payment. In the same case, once the parent company here acquire majority of the shares in B, so the parent company can issue its own shares as a form of payment. So therefore, this is a consideration paid. Paid by the parent company issuing its own shares. Issuing its own what? Its own shares. In most of the questions whereby the purchase consideration was in form of a share exchange, the examiner will tell you that the parent company had not computed and accounted for the share exchange consideration. So therefore, how do we compute the share exchange consideration? The share exchange consideration. So how do we compute this? So the share exchange consideration one, this one is equal to number of shares issued by the parent company. So how many shares did the parent company issue to pay the purchase consideration? And then we multiply those shares with their fair value, or basically with their market price, on the date of acquisition. On the date of what? Acquisition. In other terms, we multiply this with the parent company shares fair value or market price on the date of acquisition. Because in most of the questions for group account, so the examiner will confuse you by giving you the market price of these two companies, the market price of the shares of these two companies on the date of acquisition. So in case you're given the market price of the shares of the parent, the shares of the subsidiary, what do you use here? You use the market price of the parent company shares, because here you are dealing with the shares issued by the parent. You must multiply that with the parent company market price per share on the date of acquisition. On the date of what? Acquisition. So once you have computed this share exchange consideration, you will also be told that the parent company had not accounted. The parent company had not accounted for those shares which were issued. Which accounting entries are made here? Which accounting entries are made? So we can look on the accounting entries which are made to account for these shares which were issued by the parent company. So number one, so we debit an account which is called the cost of investment. The cost of investment. So the cost of investment, basically, this is an account whereby the parent company records the purchase consideration which was paid in acquiring a majority of the shares in the subsidiary. If the purchase consideration which has been computed here is 200 million, it should be debited in this account. And then the parent company issued shares to pay this. So therefore, what we do is that we credit the parent company ordinary share capital. And in this case, you have to recall the amount which is credited in this account. That is something we covered in the topic of published financial statement. The amount which is credited in this account is always based on the par value per share. fair value per share. You see, we have said when computing this, we compute this based on the fair value per share, the market price per share. So market price and the fair value are two different values. So market price is the value at which the shares of the company are trading in the securities exchange market. The par value per share is the value of the share as stated in the capital clause of MOE. So those are two different values. The amount we credit here has to be equal to the par value. And therefore, if the market price per share is higher than this, the amount which is above the par value, then that one should be credited in the parent company share premium account. Share premium account. If, for example, the share had a market price of 15 shillings, on the date of acquisition, if the shares of the subsidiary if the shares of the parent company had a market price of 15 shillings per share, and the par value per share is 10, so you can see the shares were issued at a price of 15, but the par value is 10. So the amount we credit in this account is always based on the value of the par value of shillings 10. And therefore, the share premium per share here will be equal to the issue price 15 minus the par value. So that is something you have to recall from what we did in the topic of group account. So therefore, we have those as the various forms of purchase consideration, the cash consideration, the deferred consideration, the share exchange consideration, and basically how we deal with those considerations specifically in computation of group accounts. Maybe we can just pick up one question of the group account and maybe see whether we can be able to get a question with this aspect of share exchange. We have a number of them. And then we see how do we compute this share exchange consideration? How do we account for this? So we are not doing the entire question for group account, but I want us to look on a question having the aspects of share exchange consideration. We look on how to compute the same, and equally how we account for that share exchange consideration. So we're going to look on the first question here. Yes, can we go to this question here for August 2023? We are not doing automatic. We are not doing the entire question for group account, but basically I want us to look on this aspect of share exchange consideration, how we compute the same, and how do we account for that. So we go to this one. So this question here, August 2023, question number 3. So specifically, the first paragraph, what is it? Yes, first paragraph of that question. So basically, I've said if you go through the past papers, you'll be able to see a question on this topic. This is basically a compulsory question. The compulsory question in this paper for a part. So if you are there, please confirm. I want us to just go through that first paragraph. We see what was required. And basically, we compute that share exchange consideration and we show how it was supposed to be accounted for. I hope you're there. I hope you are there. Yes. So what are we told here? What are we told? What are we told? What are we told here? What are we told? So we are told that Pika Limited, a public limited entity, intend to expand its operation by acquiring investment in other entities. On 1st of November 2022, Pika Limited acquired 75% equity interest in Shiba Limited under the following terms. Now, once you come across a question for group accounts, the first thing you do is basically to come up with something called a group structure. A group structure is what? A group structure is basically a form of a diagram which shows the parent company shareholding in what? In the subsidiary. And in that structure, you must be having the percentage shares acquired by the parent in the subsidiary, and also you must be having the date of acquisition. For example, from that information, we are told that this company, which is called 𝐻𝐿𝐶 Limited, wants to expand its operations. And we are told, therefore, this company acquired on, that is sentence 2 of first paragraph, on 1st of November 2022, this company acquired 75% equity interest. Equity interest means that this company acquired 75% of the equity or ordinary shares of the company which is called 𝐻𝐶 Limited. This basically what we refer as a group structure. From this group structure, we can tell that this is the parent company, that is our subsidiary, and then the date we have here, this is the date we have referred to as the date of acquisition, the DOA, the popular date of acquisition there. Yes. So this is the parent, this is what? The subsidiary. So that we refer to it as the group structure. So we are told this acquisition of 𝐻𝐶 was under the following terms. One, we are told there was an immediate cash payment at a fair value of ⁻13 per share on 1st of November 2022. This is an immediate cash payment. An immediate cash payment, this is what you have referred to as a cash consideration. You have seen there is no special treatment as far as that is concerned. Therefore, that is not our interest as far as this question is concerned. Once we go to the other point, where we are told, remember these are the terms of payment, the terms of acquisition. We are told there was an immediate cash payment. Point 2, we are told an issue of 3 ordinary shares of ⁻10 par value in 𝐻𝐶 Limited for every 5 shares which were acquired in 𝐻𝐶 Limited. So this company here was to issue some shares as a form of payment. And then you're told the fair value of 𝐻𝐶 Limited shares for ⁻13 per share at the date of acquisition. The share issue has not yet been recorded by 𝐻𝐶 Limited. So that is basically the point I want us to deal with. So we are told that when this company acquired 75% of the shares in 𝐻𝐶, there was an immediate cash payment, which basically have referred to the cash consideration. That is not our interest. And then we are told that this company also issued some shares to pay the purchase consideration. That is basically what we refer as the share exchange consideration. And then in the last sentence of that point 2, we are told the share issue has not yet been recorded by 𝐻𝐶. This company issued shares to pay the purchase consideration, but has not yet recorded that. It has not yet accounted and recorded the shares which were issued. In other terms, what you must do as far as that point is concerned is to compute the share exchange consideration. We have said this one is equal to the number of shares which were issued by the parent company. This formula is very, very important. How many shares were issued by this company? And then you multiply those shares with the parent company shares fair value or market price on the date of acquisition. So in this formula, the examiner will always have given you this. Will always have given you this. For example, if we go to that point number 2, have we given the fair value of the parent company shares on the date of acquisition? Who can see that price? Actually, that should be in sentence 2. Where we are told the fair value of 𝐻𝐶 Limited shares for ⁻13. For ⁻13 what? 13. Remember, 𝐻𝐶 is the parent. So what is the parent company's share fair value or market price on the date of acquisition? So we are told the fair value of 𝐻𝐶 Limited shares for ⁻13 at the date of acquisition. So this one is already given as ⁻13. No problem with that. So the problem comes here. So this one is something which the examiner will not have given you. How do we compute this one? We go back to the same point in the first sentence. We are told an issue of 3 ordinary shares of shillings 10 par value in Pika Limited. In other terms, Pika Limited was to issue 3 shares. And basically, you're told the shares which were to be issued, they had a par value of 10 for every what? That is now the other important information. For every 5 shares which were acquired. For every 5 shares which were acquired. This company was to issue 3 shares for every 5 shares which were acquired. In this case, what we need to do, first of all, is to determine how many shares did the Pika Limited acquired in Shiba. That is the first thing we need to determine. So how do we determine the shares issued by this company? So to determine the shares issued by this company, you go to its statement of financial position, specifically at the equity. That's where you can be able to get information about what? The ordinary share capital of this company. You take the share capital of this company, this what we're doing in the topic of publish. You take the share capital of this company, the share capital, you divide that with the par value. That will give you the shares issued by Shiba. So definitely, if you go below there, you'll be able to see we are given the statement of financial position of the 2 companies. Can you give me the share capital of Shiba? The share capital of Shiba, which is the subsidiary. Give me the share capital of Shiba. I see whether you can be able to get that information. The share capital of Shiba. Share capital of Shiba. What are you getting? What is the share capital of Shiba? The capital of Shiba. I need to get that answer from each of you. I've already gotten the answer from Helen. I need to get the answer from Martha, from Aaron, from Zipporah, from Virginia, from Hassan. So can you give me the share capital? Can you give me the share capital of Shiba? The share capital of Shiba, this company, is 80,000. Still in the balance sheet, where we have the one ordinary share capital, I hope you can see we are told the value of each share is 10. That applies to the shares of Pika. That also applies to the shares of Shiba. So to determine the shares issued by this, we take its share capital, divided that with the par value, which is 10. So the shares issued by this company, that is Shiba, are 8,000. So what are we interested with here? We're interested with the shares Pika acquired in Shiba. And you have to be very keen here. So the parent company didn't acquire all the shares. The parent company only acquired 75% of the shares. So the shares acquired by Pika in Shiba will be 75% of the shares issued by Shiba. So this company has acquired 75% of the shares of Shiba. The shares of Shiba are 8,000. So this will give us what? Will this give us 6,000 shares? 6,000 shares. 0.75. Yes, 6,000 shares. 6,000 shares. And we say, please try to hurry up because of time. Computation of that should not even take 3 seconds. 0.75. 0.75 of 8,000. What are you getting here? Yes, what are you getting? Yes, so this will give us 6,000. This will give us 6,000 shares. So the shares acquired at 6,000. So what we need to do is basically to determine the shares which were acquired. Sorry, the shares which were issued by this company. Sorry, the shares issued. So we cross multiply and we divide. So we will take 3 times the shares which were acquired as 6,000 divided that with 5. Divided that with 5. So this will give us what? So 1, 12. So this will give us that 600 shares. So that is 600 shares. That is 600 shares. That is 600 shares. These are basically the shares which were issued by who? By Pika Limited. That's basically what we wanted to compute. The shares which were issued. So having that, then we can move and we compute the share exchange consideration, which will be equal to this. The shares which were issued by the parent company, that is 600 shares. We multiply those shares with their fair value, which is 13 shillings. 13 shillings. And this will give us a share exchange consideration of how much? Share exchange consideration of how much? That is 600 times 13. That will give us 46,800. 46,800. Yes. So that's basically how we compute that share exchange consideration. Then, how do we account for this share exchange consideration? The accounting entries. The accounting entries. How do we account for this share exchange consideration? So we have said we debit something called the cost of investment. The cost of investment. The cost of investment would be 46,800. And then in this case, we have said we credit the parent company ordinary share capital. So to credit share capital is to add. That's what we know. We credit the parent company ordinary share capital with an amount equal to the par value. So we take the shares which were issued by the parent company, which we know they were 36, and then we multiply that with the par value per share. Who can tell us what is the par value per share? What is the parent company? What is the par value? The par value of the parent company shares. This is the value we have within the balance sheet. The value we have within the balance sheet is what? Is 10. So the amount to be credited in the parent company share capital will be 36,000. And because the shares were issued at a market price of 13, the amount which is above 10, which is 3 shillings, that is a share premium. So that share premium will be credited in the parent company share premium account. So the amount to be credited in the parent company share premium account will be equal to the shares issued by the parent company times the amount of premium. The premium per share is 3 shillings, the amount which is above 10, So that will give us what? Give me the amount of the share premium. The amount of the share premium. So the share premium here will be 10. Will be 10 what? 10,800. Will be 10,800. So that's basically how we compute and then account for something called the share exchange consideration. That's how we compute and account for the share exchange consideration. This kind of very, very common concept as far as this particular question for group accounts are concerned. I want to give another question, which basically will be taking as an assignment. This one, December 2022. December 2022. Okay, just go to this question. I can see we have, I want us to end at 3:40. I can see we have like 7 minutes. So can you go to this question here? December 2022, which is basically question number 3A. We try to hurry up. I want us exactly by 3:40. 3:40, we end our class. I know you have maybe another class after this. I want you to take a short break before you start the other class. That's why even I've not given you a short break. I want you to give you a short break of 20 minutes before you join the other class. You have this question with you? If yes, please confirm. If yes, please confirm. Please confirm. I will be able to proceed reading that question. I hope you already have there. You already there? So what are we told? We are told that specifically we go to the first paragraph. We are told on 1st January 2022, H Limited acquired 80% of 4 million shillings 10 ordinary shares of S at par value. And then you're told the acquisition consideration consisted of 3 shares issued by H Limited in exchange for every 5 shares in S. So that is a share exchange consideration. And then you're told additionally, H Limited pays a further consideration on 31st of December 2022 of shillings 11 per share acquired. And then you're told H Limited cost of capital is 10%, and the discount factor at 10% is 0.9091. So that is still that is a deferred consideration, a consideration to be paid in the future. So we are told at the date of acquisition, the fair value of the ordinary shares of H and S were 15 and also 12. So in that case, we have two considerations. I want us to deal with both of them. We have the deferred consideration and basically the share exchange consideration. The share exchange consideration. So maybe we can start with this one, which we have said to compute this, we have to determine the number of shares which were issued by who? Which were issued by the parent company. How many shares were issued by the parent company? We multiply those shares with the parent company fair value. That is the parent company shares fair value or market price on the date of acquisition. So let's first of all, we will compute this one. So we go back to the information we have in paragraph 2, and I think there is something I've forgotten here. Remember, you have said that once you come across a question for group account, the first thing you should have always is the group structure. Basically, for you to know out of those two companies, which company is the parent and which company is the subsidiary. Maybe first of all, we can have that here, the group structure. And basically, we are told that in the first paragraph, we are told on 1st January 2022, H Limited acquired 80% of 4 million ordinary shares of shillings 10 of S Limited. And basically, the acquisition took place on 1st of January 2022. It basically means that this is our parent company and this is our subsidiary. And this date which we have here is the date of what? Acquisition. That is very important. Very, very important. So having this, let's go back to paragraph 2. And we are told the acquisition consisted of a new issue, and sorry, consisted of 3 new ordinary shares issued by H. So we need to compute this because this one is already given. So how many shares were issued by H? So we are told H Limited was to issue 3 shares. 3 shares for every what? For every 5 shares which were acquired. For every 5 shares which were acquired. So in this case, we have said we need to determine how many shares did H acquire in S. So if you check on the information we have down here, you'll be able to see that we don't have the statement of financial position of S, meaning that we can't be able to get the shares issued by S in its balance sheet. But if you go back to paragraph 1, you read that point well, you'll be able to see we are given the shares issued by S. And we go back to paragraph 1. We are told on 1st January 2022, H Limited acquired 80% of the 4 million shillings 10 ordinary shares of S. So the shares issued by this company S are 4 million. That information is given. So therefore, we need to determine how many shares did H Limited acquired in S, the shares acquired would be 80% of the shares issued by S. That is 4 million. 4 million. And basically, this will give us 3.2 million shares. 3.2 million shares. So we want to determine the shares which were issued. We cross multiply, then we divide. We have 3 times 3.2 million. We divide that with 5. So this now will give us the shares which were issued. This will give us what? This will give us what? Yes, I'm given that figure in 1,000 of shillings. In 1,000 of shillings, I'm told that this one would be 1920 shares, but in 1,000 of shillings. So having that, what would be our share exchange consideration? We take this one, which are the shares which were issued, 1920. We multiply that with the parent company share fair value on the date of acquisition. And actually that information, we have it up there in paragraph just above the statement of profit or loss. So we are told there is a paragraph which reads, at the date of acquisition, the fair value of ordinary shares of H and S that is the fair value of the ordinary shares of H and S was 12 and was 15 and 12. So what we're interested with here is the parent company share fair value. Is that 15 or 12? On the date of acquisition, what is the market price of H Limited shares? Is it the one which is 15 or is it the one which is 12? 15 or 12? That one is 15, is 15, is 15. So this is how we compute the exchange consideration. Exchange consideration times what? Times 15. So this will give us 28,800. 28,800 what? 800. So that is the share exchange consideration. The share exchange what? Consideration. The share exchange consideration. Then, can we deal with this one? The deferred consideration. We go back to the information we have in paragraph 3. We are told additionally, H Limited, which is the parent, this one, additionally, H Limited will pay a further consideration on 31st of December 2022. So remember, the date of acquisition is 1st January 2022. We are told this company will pay an additional consideration on this date. Basically, you can see this exactly after 1 year. After one year? So that is a deferred consideration to be paid 1 year after acquisition. So we are told it will pay a further shillings 11 for every share acquired. So we need to compute how much amount will be paid. It will be equal to 11 shillings for every share acquired. So how many shares did H Limited acquire in S? I hope you can remember you have computed that down here. The shares acquired by H in S, we have said were 80% of 4 million. So the shares H Limited acquired in S were how many? 3.2, 3.2 this one. So therefore, the amount to be paid after 1 year will be 11 shillings per every share acquired. We take 11 shillings times the shares which were acquired. So this is the consideration to be paid after 1 year. We multiply that with the present value interest factor, at which rate we are given the parent company cost of capital, which is 10%, and basically this will be paid after 1 year. Will be paid after 1 year. Yes. And I think in our case, this figure is already given for us. Is given because in terms of how we compute this, we should take 1 plus R raised to power negative n. It should be 1.1 raised to power negative 1. And this is the one which should give us 0.9091. And basically that is what here given. Is that what we should get there? Maybe you can just confirm. 1.1, we raise that to -1. Yes, it should give us that. So therefore, the present value of the deferred consideration would be equal to this. will be equal to this, which is what? 11 times 3,200, and that will give us 35,200. So basically, whatever you get here times this, and basically it is equal to that. So what are we getting here? Times 0.9091. 91. So basically, in that case, I'm getting the present value of the deferred consideration as that amount. So as that amount. If you work out with this one, Aaron, if you work out with that, it should give you exactly 32,000. 32,000. 32,000. Are you getting that? Yes, 32,000. So basically, that is how we deal with that particular aspect of deferred consideration and also the share exchange consideration. So once we meet now in our next class, we will be able to proceed and basically look on how we prepare the consolidated financial statements, specifically whereby the parent company has invested in what? In a subsidiary. So therefore, for today, I want us to stop at that point. We will continue from there in our next class. But even before we meet, can you ensure you are grouped on what you have discussed today? Yes, because it is very, very important. Goodwill and also the various forms of purchase consideration. So have a nice weekend. Let's continue from there on Tuesday.